Morning. My name is Ayodele Oshunkoya. I'm a relationship manager at FBNQuest. We hope you're keeping safe in these times, and thank you indeed for making the time out to attend this edition of Leading Conversations with FBNQuest. The theme of this season is diversification opportunities with high potential returns. We intend to discuss the various investment opportunities available and how to grow your wealth. While we wait for other attendees to join, I'd just like to give a brief background about the Leading Conversations with FBNQuest. Leading Conversations with FBNQuest is a webinar series created to bring you market, industry, and consumer insights and analysis that are crucial for individual and corporate success. The series will feature the leading professionals of FBNQuest, as well as other industry experts with experience in corporate and private investment management, wealth preservation, financial advisory, and other areas of interest. We hope to open your mind to a world of opportunities through this session, and we very much look forward to engaging with you. This session will run for an hour, and the speakers are Ifeoluwa Dixon. She's the head fixed income FBNQuest. The second speaker is Laura Fisaya Kolawole, who is also the head equities and alternatives. So I'll start with the first speaker, and I'll give a brief introduction. Ifeoluwa Dixon is a senior vice president and the head fixed income portfolio management at FBNQuest Asset Management. She also doubles as the lead portfolio manager of the FBN Money Markets, FBN Fixed Income Fund, and FBN Eurobond Fund. She currently manages about 350 billion assets under management. Ifeoluwa has about 15 years professional experience, which spans across portfolio management for institutions and retail clients. She's a certified treasury professional, Ethica Certified Islamic Finance Executive, and Ethica's Advanced Certified Islamic Finance Executive. Ifeoluwa has key competencies in portfolio management, financial statement analysis, as well as tracking and forecasting microeconomic and other key indicators. Please note that there will be a question and answer session, so please drop your questions in the chat for us. I'll be handing over to Ifeoluwa Dixon now, and she'll be discussing the importance of diversification. Thank you.
Thank you, Ayo, for that introduction. And good morning, everyone. Thank you for joining Leading Conversations with FBNQuest, our webinar series. And like Ayo mentioned, we'll be discussing on diversification opportunities, and that's the broad topic for today. And I would like to start by saying, at this moment in time of our lives, right, investing is all about the future. It's about ensuring you have the real resources to provide for a healthy and happy life. As long
Hello, Ife. I think we lost Ife there. Please just give us some few minutes for Ife to get back on. Apologies for that, please.
Can anyone hear me?
Ife, we can hear you now.
All right.
Please go on.
And apologies for that. And so, two things we would like to have at the back of our minds during these webinar series is the impact of COVID-19 on our investment, and also the effect of inflation on our investment as a whole. And so 2020, we all woke up and then we saw the pandemic, and Q1, towards the end of the Q1, the effects came in strongly and it's badly affected our investments as a whole. And also the negative effect of inflation printing in Nigeria at 14 levels, and why a one-year bill is at 0.15 is alarming to actually say. And so we'll be dwelling again on diversification and the whole essence of it, and how you can actually earn more, during this period, rather than just live with the 0.15 that you have. And so what is diversification? Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio across different asset classes, countries, currencies, and geographies as a whole. And so the rationale behind this technique is that a portfolio constructed of different kinds of asset classes will, on average, yield higher long-term returns and lower the risk of any individual holding or security. And so we're here to say that a well-diversified portfolio contains a mix of distinct asset types and investment vehicles. And so just putting your egg in one basket is not advisable. You just need to spread your risk. And at this point, I would like to stress that diversification seeks to minimize the risk and not eliminate the risk outrightly. Next slide, please. And so why now? Why have we chosen today to talk about diversification? There is no other time than now, to be honest. Like I mentioned earlier, 2020 with the COVID and even inflation eating us hard in Nigeria. The unprecedented turbulence accompanying the global pandemic has made many people to rethink about their financial well-being. And so amid volatile equities, low interest rates like we have in Nigeria, then really diversification in personal investing be more essential than now. Millions of people are looking for how they can earn more on their investments rather than the 0.15 that we currently have in some of our government securities. And largely most of the fixed income instruments at the moment are yielding negative real returns when you compare it with inflation. And so diversifying investments is seen as the best strategy now as much as ever. And that is why we've put this series together to say we need to diversify. Now, risk, like I mentioned, the whole essence of diversification is not to eliminate, but to minimize risk. And what are these type of risks? We have two. One that cannot be diversified. We have another that can be diversified. The one that can't be diversified, we call it undiversifiable risk, also known as systematic or market risk, right? And these are risks that investors must accept, and like I said, cannot be reduced through diversification. A good example, again, is inflation, political instability, and you have interest rate as well. While on the other hand, diversifiable risk, the ones that you can reduce, the diversification can reduce, and with the help of the portfolio managers, these type of risks are, related to industry, markets. It could be business risk or financial risk as well. And so the whole essence of this is to engage with the portfolio managers to construct a well-diversified portfolio so that you can enhance returns on your investments. Next, please. Next slide, please. While we wait for the slides, can I move on? Ayo.
Yes, please. Please move on.
All right. While we wait for the slides, I would like to touch on the importance of diversification. Given the challenges that come with investing, one way to reduce, again, not to eliminate, risk is to diversify. Diversification serves as one of the best ways to weather market volatility, as the potential risk level is reduced by spreading investment across and within different asset classes, financial asset classes. And so we have equities, we have fixed income, you have real estate, you have cash, you have derivatives as well, commodities as well. So these are financial assets that a portfolio, well-diversified portfolio should have at this point in time to enhance returns. And so why do you need to diversify your investments? Really, three things comes to my mind. One is to spread your risk. And so the concept of risk spreading is for investors not to put all their funds in only one investment asset at a single point in time. Yes, when Treasury bills was doing the high double digit levels, investors, just put their monies in government securities, earning the 18%, the 20% yields without diversifying. But at this point in time, when rates are sub 1, even 10, moving towards negative 0.15 on a 1-year bill, this calls for a way to review portfolios and to encourage investors to diversify. So this is like the popular phrase, do not put all your eggs in one basket. This is because if an investor invests all his funds in one company or business and it fails, which we saw during this pandemic, the investor may lose everything. And so when individual financial assets can suffer severe declines, it is very rare that any 2 or 3 assets at the same time would have the same risk and returns. And so they would have different sources of risk and returns, and that would bring about the enhanced returns that we're talking about today. Opportunity for higher returns as well. Going by another popular phrase, the higher the risk, the higher the potential returns. However, when you diversify, you minimize it and you balance it. So when you have a low return somewhere, a low risk, the higher ones as well will blend together and you have a comfortable risk and a good returns. And so diversifying your investment provides you the opportunity to get higher returns while maintaining the same level of risk. It also reduces exposure to volatility. And so different markets have different levels of associated risk with different dynamics. I mentioned earlier that one of the things you need to do when you're diversifying your portfolios is you consider the asset classes, you consider currencies and geographies. And this as well speaks to that geographical location to say you shouldn't put all your investments in just one market. Diversifying is not just having equity and fixed income in Nigeria alone. It would be nice if you have exposure to dollar assets likewise. And so a well-diversified investment across different markets will help mitigate the effect of inherent volatility associated with each market, given that there is little or no level of correlation between these markets. And a good example is our FBN Eurobond fund. And so we would encourage investors when they are reviewing their portfolios to have a portion of their investment in a dollar-based mutual fund that we have to offer. And also someone may be saying or thinking, are there issues with diversification? And the answer will be yes, it is not that perfect. There are issues. And so that is why, again, the portfolio managers are here and the relationship managers as well to handhold everyone in this room as we navigate this journey together. And so there is a need for you to have a professional assistant in this journey. Yes, we have some people that will say the DIY, do it yourself. But with these issues, you can't just do it yourself. You need a professional assistant. And that is why FBNQuest has put this webinar together to navigate people through it. And so I would close with saying that investment can be spread between mutual funds, which are inherently diversified with a wide range of securities. And we have such at FBNQuest Asset Management. And over the long term, diversified portfolios do tend to post higher returns. These are facts. When you have a bit of equities, you have a bit of real estate, commodities, and all sorts, and even dollar-based investments as well, then you tend to have a higher returns on the long term, not short term. And so it is important for us for people in this room to construct their portfolios so that it is well diversified and they have appropriate allocation, meaning not just being exposed to one asset class or market or currency. A lot depends on individual goals, and there is no one size fits all. And that is the whole essence of this webinar again, to say we are here to assist and to make the journey smooth for all our investors. Thank you very much for having me on this series. Over to you.
Thank you very much, Ife. That was very insightful. I guess the takeaway would be don't put all your eggs in one basket. Thank you very much, Ife. Ife just discussed about importance of diversification. And thank you everyone for listening. Please don't forget to share your questions via the chat room. I'll be handing over to the second speaker, who is Laura Fisayo Kolaoli, and she'll be speaking on what you can do with your money. But before I hand over to Laura, I'd like to introduce Laura to everyone. Laura is the head of equities and alternative assets portfolio management at FBNQuest Asset Management. She's responsible for the investment strategy and solutions development within the multi-asset portfolio management team, leading a diverse team of portfolio managers and product developers. Laura specialized in UK equities, working with the team responsible for managing the UK equity portfolio for the investment management clients fund. Laura was also part of a team that executed global multi-asset portfolios with almost $1.5 billion in assets under management. So Laura, thank you very much for joining Conversations with FBNQuest. Please, I'll be handing over to you. Thank you.
All right, good morning, everyone, and thank you so much for joining us. I hope you can all hear me. And I think for me, the core thing I'm here to talk about is what we can all do with our money. Many times I found that with Nigerian investors, a lot of us are guilty or have been guilty in the past of just enjoying the high returns that come from low risk assets. And many of us were simply invested in money market instruments. And for a lot of us this year, that has been something of a shock to see how interest rates have fallen. I'm starting off with this slide. I don't usually like starting off with returns, but I think that it shows that regardless of your risk profile, whether you are a low risk investor, whether you think that you are, you're high risk, whatever it is that you think you are, you can be diversified. One of the things I liked that Ife said when she spoke was, or rather the way I understood what she said was that, with diversification, you can create a portfolio based on your composure. So for me, what that means is that I can create an investment journey for myself that is palatable to me by diversifying my investments. I can, if I'm low risk, if I'm cautious, if I am an aggressive investor, I can create a portfolio with various products, various solutions that suit me, suit my risk profile, and also suit my investment goals. And on this slide, what I'm showing is, you can make some of our Nigerian-based, our Naira-based solutions. So if I look at the cautious balance, for example, say as an investor, you are cautious balance. What I mean by that is you are willing to dip your toes into the equity market, but not so much as to jump in there whole high, jump in there with your 2 feet. And so what that means for us is that you can mix up a portfolio that has about 70% in fixed income and about 30% in solutions that have some level of equity exposure. And you would have earned about 15.96% this year, so about 16% this year, as an investor, and still have a risk profile that is palatable to you. And that's really what diversification is about, what Ife was speaking about. So on the next slide, I just thought I'd spend some time talking about why 2020 has been special. This year has been, I think, quite interesting for a lot of us investors. And there are two broad things that brought us to where we are. The first one on the left-hand side of the slide are the things that the CBN has done. And on the right-hand side, the second one is COVID. So on the left-hand side, a number of interesting things the CBN did over last year and this year that have brought us to where we are today. The first one is encouraging banks to loan out more money. The CBN came out last year and put in a 65% minimum loan to deposit ratio for all banks. What that means is that for every deposit that the bank has, every 100 naira they receive as deposits, the central bank expects them to loan out 65% of that, so 65 naira. Now, for a lot of banks, they were quite reticent to lend. And so what that has meant is that many banks have tried to meet that minimum requirement by reducing their deposit base and lowering the interest rates they offer on fixed deposits and other banking deposits so as to discourage investors from keeping monies in the banks. So what that has meant is that has caused fixed deposit rates and bank interest rates to decline as a way for banks to meet their minimum loan to deposit ratio. The second thing the central bank did was to stop local investors participating in what they called open market operations, OMO, as it's popularly called. The central bank uses these open market operations to try to control the amount of money in the system. So they used to offer, prior to last year, used to offer all of us investors these high interest rates, essentially treasury bills, to encourage all of us to give the CBN our money. They issue us these high interest rate securities as a way to control the amount of money in the system, as it was called. Now, what they did last year was they said, you know what? We would no longer allow pension funds and other local investors, so asset managers like ourselves included, from participating in these open market operations. So suddenly, a large chunk of the treasury bills that used to be available to a lot of us local asset managers were suddenly gone. We all had to contend with a tiny portion of the market and buying treasury bills issued by the debt management organization, the DMO, who issues debt on behalf of the government. What that suddenly meant was that all of us were chasing this very tiny subset of treasury bills. Suddenly, interest rates there crashed. And that is why treasury bill, Ife had mentioned, for example, that the 1-year treasury bill at the last auction, which closed yesterday, closed at 0.15%. And that is essentially telling you that the government is borrowing 1-year money at 0.15%. That is there because a lot of us are trying to buy these bills and are bidding lower and lower and lower. Hence 0.15% per annum is where the 1-year treasury bill is. And that's because the access to the OMO was removed for local investors. A number of other circulars came out, all in the bid to control the local market. But I think the biggest thing that I would say the CBN has done is that they have persisted. When these changes happened last year, a lot of us, myself included, were quite skeptical. We all felt that, give the CBN a year, a month, call it what you like, that these things will be rolled back and the high interest rate regime that we had all enjoyed for many years will continue. But the CBN has shown us a level of resilience that I don't think anybody expected of them, at least market participants, I mean by anybody. And so with every day that the CBN has held on to this low interest rate policy, and that the government on the fiscal side has supported the low interest rate policy, with every day that that passes, we're seeing lower and lower Naira interest rates. On the other side, it's COVID. Now, COVID was something that none of us predicted, right? And the effects of COVID, I think, have been, or in fact, all of us, I'm sure, are quite aware of all that COVID has done for us. So the first one is the lockdown. Lockdowns to try to stop the spread of COVID, to try to protect us as a population. But the lockdown then has a knock-on effect on economic activity, because really locally, but also globally, activity slowed down quite dramatically. And as a result of the slowdown, our government included, but really all governments, are trying to use fiscal measures to try to push the economy. So, for example, the government has proposed a 13 trillion naira budget for next year, called the Budget of Economic Resilience and Recovery. The final thing that the pandemic has done for Nigeria, Ife talked about inflation being at 14.23%. And that, that is partly because of the pandemic. So what the pandemic had done is that, as a country, we have a lot of supply side problems. We have a lot of supply side inefficiencies, really because of our weak infrastructure base. And what the pandemic did was to exacerbate that, such that we're having high inflation due to issues on the supply side, not necessarily because of demand. And I think that's the reason why, despite the high inflation, we're still seeing quite an expansionary central bank policy. They keep it, they they've cut the interest rate twice, for example, in the last year, despite high and rising inflation. And that's really because they're saying to themselves and to all of us that the inflation is not really caused by monetary policy, it's not caused by demand side factors, it's really caused by supply side pressures. Now, on the next slide, the two things I mentioned, I talked about the CBN policy, I talked about COVID, and how those things have caused a lot of demand on money market instruments. What we have seen as a result of that is a dramatic decline in interest rates on the money market side. There's been a lot of liquidity in the system. We have high system liquidity. We have very little investment alternatives. I talked about the fact that banks are no longer taking money, which was the fixed deposit space was a large money market asset class that really has been removed as a result of CBN policy. And the fact that the monetary and in fact the fiscal authorities seem quite happy with the low interest rate environment, as they should be, because the low interest rate environment really means that the government can fund her debt requirements and hopefully, infrastructure and all the nice things for the economy at low interest rates. Because to be honest, if we have a government borrowing at 15, 16, 17%, that really in economic terms crowds out investments from private individuals, because as a company, what rate would I borrow at if my government is already borrowing at 16, 17, 18%? So when interest rates are low, potentially it helps to have a better credit environment for private money. But that aside, those three things really have caused low interest rates. And we've seen the yield of the money market fund on the right-hand side really fall in line with markets. And a lot of us investors have been caught out because the bulk of us Nigerian investors are generally overweight money market. On the next slide, what I try to show is that, as a house, we try to ensure that our clients are able to enjoy differentiated returns, benefit from all markets with the solutions base that we have as a business. A lot of our clients, like I said, are familiar and invest in the FBN Money Market Fund, which is really our lowest risk solution. It's essentially a cash solution. And frankly, at the time when interest rates were very high, it was a nice solution for clients to have, because essentially you were enjoying high risk-free returns, low risk. There was really no reason to allocate higher up the risk curve. But we also have a number of other solutions invested in fixed income, equities, across the risk curve, that help, or that can help investors along their journey. And really, the very first slide I showed was really showing how you can mix and match these solutions based on your risk profile to help you create the kind of journey that is palatable to you, the kind of journey that's based on your own composure. So the fixed income fund, for example, is a bond fund, and right up there at the top, the Smart Beta fund is an equity fund. And within there in the mix as well, we have the Eurobond fund, which is a dollar fund. Ife had alluded to the fact that it is right to diversify, not just across asset classes, but even across currencies, as a way to give yourself the best chance as markets move. And that's really what we, with the array of solutions that we have, the idea is to help clients create that journey that works for them. Now, this next slide, and I apologize in advance, I know it's quite busy, but for me, it's an interesting slide. And I think if you permit me, I will talk through it. When I look at the way our Nigerian or Naira-based solutions have moved in line with market trends, you will see for yourself the benefit of having a diversified portfolio. And the graph at the top is how our Nigerian markets have moved. The magenta line, that dips the lowest in the second quadrant of the graph is the equities market, and that's represented by the returns to the Nigerian Stock Exchange All Share Index, the ASI. The gray line, which ends up rising the highest at the end of the graph, to the right-hand side of the graph, is the return to our bonds market, and that's represented by the return to the Bloomberg Nigeria Sovereign Bond Index. So that really is trying to show the returns to FGM bonds this year. And the blue line that is not so visible, that's almost at the axis of the graph, is the yield of our Nigerian money market, and that's represented by the 91-day Treasury bill yield. Below, we're seeing returns of our mutual funds. So the magenta line represents the return to the FBN Balance Fund, the gray line to the FBN Fixed Income Fund, and the blue line that's flattish to declining is the return to the FBN Money Market Fund. And those returns really correlate to their underlying markets, which makes sense because, our funds are invested in the underlying assets. So it makes sense that the returns of the funds should follow the returns of the markets. Now, when I look at this year for us, if I start at the left-hand side of the graph, January started strong. A lot of us came into this year with a lot of euphoria about 2020. And it was really a positive start to markets. Equity markets rallied quite a bit at the start of the year. And even bond markets, saw good gains to start the year. But by about March, the pandemic hit. And we saw a lot of market weakness really led by equity. So you can see that by March, April, equities in the graph at the top had declined quite a bit, had declined about 20% by the time we got to April. But you can also see, and Ife had spoken about diversification and holding assets that don't move to the same magnitude in the same direction all the time. And we can see that where equities declined quite dramatically, money market yields, were steady-ish to slightly declining. Bond returns did decline, but picked up, such that an investor who was exposed to equities alone would have had that decline quite dramatic. The one we're seeing in the graph at the top, by about April, that decline, they would have that. But an investor who had bonds as well would have enjoyed a bit of a pickup, as time went on, because we're seeing that bonds and equities didn't move in the same magnitude, same direction at the same time. But really, as the year went on, and as we saw money market yields keep declining, investors began to to jump into bonds, right? They began to jump into bonds quite a lot. And so we're seeing that bonds, rallied quite strongly. And if you look at the gray line at the top graph, you see that bond returns this year have really been, I guess, the best returning asset in Nigeria. So there's a lot of talk about equities recently. A lot of investors are sort of talking about how we've seen an equity rally, recently. And we saw that, from about September, October. But what's more interesting to me is that we've seen a very, very strong bond rally, and that rally has really happened through the year, starting in about April. And that's the gray line at the top. And it was only when bonds really reached what I would call heady valuations. I mean, it was really bonds have become quite expensive that we've now seen investors move to equities. And, for me, this is instructive because what low interest rates do for us, for all of us as investors, and really is the reason why we're all here, is that when interest rates are low on the risk-free side, we all start looking for what to do with our money. And the first thing you jump to is the next sort of lowish risk thing. When you've done that for a while and you still need more return, then you jump to the next thing. And that's what's happening. And that's why we're where we are today. And the returns of our mutual funds at the bottom have really followed the same trend. And so there's really no need to talk through it because it has just worked in line with the underlying assets. So on the next slide, what I'm really saying with this presentation is that diversification is important. We expect that the diversified returns profile that we have seen this year is likely to continue. Like I mentioned, the posturing of our monetary and fiscal authorities is that this low risk environment is good for all of us, at least for them. It's what they want. And so with that, we expect that investors who are looking for returns would have to move to the Naira stock and bond market. And so it's likely to remain attractive for investors. I talked about inflation. Inflation is at 14.23%. So really just by existing, your Naira is losing 14% on an annual basis. So we all have to look for new and different things to do with our money. And so we recommend allocating a portion of your portfolio really based on your overall risk tolerance to products with exposure to riskier assets. The final thing that we ask investors to do is to also consider diversifying on a currency basis. And really, the next slide, I think, speaks to the kinds of solutions that we have as a business that can help investors on this journey. I've mentioned here, excuse me. I've mentioned three sort of funds that we have. Excuse me. I've mentioned three funds that we have that are interesting and helpful for investors. The first one is the FBN Balanced Fund. Like I talked about earlier, this Balanced Fund helps investors dip their toes into equities because it only invests about half of its asset in equities and the other half in fixed income. And so it allows you to create a more palatable journey when you want to expose yourself to equities. The fixed income and Eurobond funds are really both dollar funds, where the fixed income fund is Naira, the Eurobond fund is USD, but they both invest much of their assets in bonds. They're both actively managed, and they both offer you a way to get competitive returns from, in fixed income's case, Nigerian bonds, and in the Eurobond case, Eurobond assets, competitive USD returns. And the minimum investment for the Eurobond fund, I think, is $2,500. So really, it's available for all investor types to enjoy. Now, this slide again speaks. This next slide speaks to our, a couple of our solutions, or rather 4 of our solutions, and just showing the kinds of features that we have with our different mutual funds. And I think for me, the one thing that stands out is regardless of your risk tolerance, regardless of the kind of assets you want to be exposed to, we have something for everyone. All our funds are actively managed. All our funds are diversified. All our funds are suitable for long-term investors. We have a fund that is Sharia compliant. So for our investors who are inclined to have Islamic products, we have a fund that Sharia compliant, the Halal Fund. Ife had, well, when I was introducing Ife, she spoke about how Ife is certified as an Islamic finance advisor. We have funds that are for investors who are looking for income, funds for investors looking for capital growth. All our funds are frank, at the end of it, are all open-ended. What that means is that as an investor, you can come in and come out of the fund at your will. So it depends on you. You can create the kind of journey that you want with our investment products. So I end again on the slide that I started with. And that is a slide that, again, is showing how you can mix our Naira-based solutions based on your risk tolerance, based on your risk profile. And I'm hoping that, having spoken for the last, I think, 20 or 30 minutes, I'm not sure, this slide makes more sense to you. So I think I'll just stop here. Thank you very much.
Okay, thank you very much, Laura. That was very good. Thank you. At this point, we'll be taking questions from the chat room. I'll read out the questions and I would have Laura and Ife respond to them. Okay, so the first question, maybe I'll let Ife to take this. Talking about diversification, is it advisable to invest in an investment you know little or nothing about?
I can't hear you clearly. Can you speak up?
Okay. Talking about diversification, is it advisable to invest in an investment you know little or nothing about? Did you get that?
Talking about diversification, is it advisable to
invest in an investment you know little or nothing about?
You know little or nothing about?
Yes.
All right. Thank you very much for that question. And that is why we are here at FBNQuest Asset Management, to say you don't have to know it all. You have your relationship managers to handhold you and the portfolio managers to ride the journey with you. And so for our mutual funds, that's the whole essence of the mutual funds, where we pull funds together and we invest on behalf of unit holders, and they all get the same returns, be it the money market fund, the balanced, or the Eurobond fund. And so when you are not an expertise, and it is not a crime for you not to know, that's the truth. It is not a crime for you not to know, but your portfolio managers and relationship managers are there to act in your best interest. And so as little as 5,000 Naira, you can invest in some of our mutual funds. Even I've seen questions regarding non-interest rate, which is Sharia compliant. We have funds for such investors as well. So yes, you can invest without you understanding the underlying assets. All you need to know is your risk. What do you want and your expected returns as well. Thank you. And I hope that answers the question, if I heard correctly.
Thank you, Ife. I'll go to the next question, and this should be for Laura. Could you please provide insights into the classical textbook investment response to a regime of high inflation and low interest rates markets, irrespective of what the current Nigerian investment trend of equity investments is?
Hi, Ayo, could you take it again? I'm not sure I understood the question.
Okay. Could you please provide insights into the classical or the textbook investment response to a regime of high inflation and low rates interest markets, low interest markets, irrespective of what the current Nigerian investment trend of equity investments is? So it's basically asking, right now that we have high inflation and low markets, rates, what is the Nigerian perspective, to the equity investments?
Okay, Okay, so from what I answered that question, I think I'd say a couple of things. So first of all, in classic economics, when you have high interest rates, you expect to have, when you have high inflation, you expect to have high interest rates. And the reason for that is, if you think of your interest rate as really the price of your money, when you have high inflation, what you try, the way central banks generally counter high inflation is to have high interest rates, so as to reduce the amount of money in circulation, to bring down the price of your money, and to help shore up the value of your money. And so generally, when you have high inflation, what we find is many central banks will begin to do things like increase their interest rates when they have their MPC meetings, or whatever they call it in various countries, to try to control the level of inflation in the economy. When I was speaking, I mentioned the fact that despite high inflation, our local central bank is choosing to maintain a low interest rate regime, and is quite comfortable with that interest rate regime, even though classic economics means that low interest rates means lots of money in circulation, means lots of liquidity in circulation, looking for something to do, which tends to put more pressure on inflation. And the reason I mentioned at the time as to why our central bank is taking that view is because they're saying inflation that we're seeing in Nigeria is not caused by demand side factors, which can be controlled by moving your interest rate, but is really caused by supply side weaknesses. Let me explain. When you have low interest rates like we have today, I have a number of investors who say to me that, given where interest rates are, what am I doing investing? I should just take my money and spend it, take my money and do something else with it, whatever that something else is. And for many investors, that really means spending. Because if I'm going to earn 0.15% for 1 year, I might as well spend the money. Whereas if I'm going to earn 20% for 1 year, I might be tempted to invest. So what that means is that low interest rates tend to mean lots of money in circulation, looking for something to buy. On the inflation side, if I have lots of money in circulation looking for something to buy, and we all start trying to buy, let's say, apples, what that means is that the price of apples go up, and that speaks to inflation. That kind of inflation is demand push, because really lots of us are demanding this good, and we're demanding because we have nothing to do with our money. We're saying, look, we can't, there's no point in investing our money, so let's all demand products in the economy, which pushes up inflation. That's why central banks generally respond to high inflation with high interest rates. But our central bank is not doing that. What that means for equity returns is a couple of things. On the one hand, we're all looking for something else to do with our money. That means I can either spend my money or I can move up the risk curve in investing. I can start investing in things I wasn't willing to invest in before. So again, I'll take my other interest rate. So if my interest rates are at 15%, I start thinking, why take the risk of buying equities? Because equities can go up and down. Why invest in something that I can lose money in when I can earn 15, 20% from just being in low risk assets? When interest rates are now 0%, as we have today, we all start thinking perhaps we should invest in equities. And that means positive equity return. Thanks.
Okay, thank you, Laura. The next question will go to Ife. You mentioned the FBN Eurobond Fund as an option or window for diversification. I invested in the FBNQuest Money Market Fund. Which of your products in FBNQuest can I diversify? Ife,
Thank
did you get
you
that?
for that question.
So the client is asking, which investments can he also diversify his portfolio in aside the FBNQuest Money Market Fund?
Thank you. So we have the FBN Balanced Fund, and the FBN Balanced Fund has exposure to money market instruments, to bonds, and to equities. So in a way, that is a diversified portfolio. However, no exposure to currency or to outside of Nigeria. And so you can have a bit of that, and also the FBN Eurobond Fund, which is a dollar-based fund, in a way to mix it up in terms of your dollar exposure to complete what we called diversified portfolio of currency, geographies, and asset classes. Also, we have the FBN Smart Beta Fund that has a greater exposure to equity and also to fixed income instruments. But if you're talking in terms of a properly diversified fund and you just want to pick one fund, you will go with the FBN Balanced Fund and also FBN Eurobond Fund. So two funds really would make you to have a proper diversified portfolio. Thank you.
Thank you very much, Ife. Please, I'll still have you stay on for another question. Can you throw more light on FBN Fixed Income Fund? How does it work?
So the FBN Fixed Income Fund, in plain English, is a bond fund which has a minimum of 70% in bonds, be it federal government bonds, corporate or state bonds, and then 30% in money market instruments, your CPs, your T-bills, and bank placements. Now, for us in FBNQuest Asset Management, we do mark our bonds on a daily basis to reflect the true worth of individuals' holdings. So when you come in at our offer or bid price, at our offer price, you go out at a bid price. Now, it's so transparent that you can know what you would get at the end of your investment when you use the bid price on the day of your exit. And like I said, again, it's just a bond fund, which has minimum holding of 70% in government and corporate bonds. That's just, but yeah, because we mark to market, people tend to see varied prices on a daily basis. But overall, in the long term, it's always positive. You have a real return, currently the fixed income fund is doing on an average of 24% year to date. And that's for people that have been in the investment since start of the year till date. Thank you.
Thank you very much, Ife. I think I can take one more question for now. Okay, so there's a question here that says, diversification in the various FBNQuest portfolio, can it relate to stocks and bonds of other external bodies? Where is the place of foreign bonds or stocks, and how can one get access to it? That is investment in stocks and bonds abroad. Laura, please, can you take this?
Hi, thanks. Okay, so two things. Ife had talked about the Eurobond fund. So for us, we have a Eurobond fund that allows investors to earn dollar returns. Now, Eurobonds are, in the Nigerian context anyway, are instruments that are issued in foreign currency, in most cases in dollars, by Nigerian entities. So that's one way you can get dollar exposure. The other part of the question to me spoke to buying actual foreign bonds, i.e. foreign entities and foreign currency. Right, Ayo, is that a fair understanding of the second part of the question?
Yes.
Yeah.
I think access to foreign equities.
Exactly. So yeah. So what I would also there's Nigerian foreign and there's foreign. So on the foreign side, it's possible in the sense that you can buy foreign currency, foreign denominated, foreign obligo securities. The constraint, I think, for many retail investors tends to come from size, because for many of these instruments, to access them, you have to have quite a bit of money. As a fund management house, it's something that we can put together for investors, but it's a conversation that we have with investors almost on a bespoke basis. Thanks.
Okay, Laura. I'll just take one more question before we round up. Apologies, everyone. You can share your questions. I'll send out, I'll call out the email to send your questions to, and you can actually reach out to your relationship manager or any relationship manager with FBNQuest. So the last question is, can the CBN influence the returns on FBNQuest Eurobond fund like it's done with Treasury bills? Ife?
Thank you. So, not to say no outrightly, but that's what the answer will be at the end of my conversation, really. To say it can't. And that is the whole essence of all this discussion as well, to say when something is affecting you in a country, it can't in another, because it's a dollar-based investment. So even if there is a devaluation or depreciation in our local currency, it works in your favor when you have exposure to a dollar-based product. That is one. Two is what investors in the Eurobond space, what they watch out for are your fundamentals, political stability of a nation, your policies as well, your commodities as well, in a way tends to affect us as a nation because we are mono economy. We only produce crude oil, right? And so when there is a problem with crude oil prices, it tends to affect us in a way, but not that CBN can just come up with a policy just like that to say, even if CBN should devalue, it works in your favor in the Eurobond fund in a way. So I would say no, it can't. It can't affect it the way it has affected other local currency funds.
Thank you very much, Ife. And thank you everyone for joining. Please look out for more information on our next webinar on our social media channels at FBNQuest. I see there are a lot of questions in the chat room, and we might not be able to take all those questions right now, but you can send your questions to webinars@fbnquest.com. I'll say that again, webinars@fbnquest.com. Or you can contact your relationship manager at FBNQuest. We have several more insightful and relevant topics planned in the coming weeks and months. Please follow us on our social media platforms, Twitter, Facebook, Instagram, and LinkedIn at FBNQuest today, so you don't miss out. Thank you very much for joining. We wish you a safe and productive day ahead. Thank you all.